Most people have checked their subscriptions at least once. They added them up, looked at the total, and decided it was manageable. But the number they reached was wrong, not because they miscounted, but because they measured the wrong thing. They calculated cost. They did not calculate opportunity cost. Those are not the same number. One tells you what you spent, the other tells you what you gave up. The average household is running somewhere between $300 and $400 a month on convenience services, streaming, delivery premiums, app upgrades, storage tiers, task outsourcing. That figure, invested monthly from age 28 and left untouched for 37 years, does not stay at $300 a month. It compounds. By the end of this video, you will know exactly what your convenience stack is worth, not what it costs. Part 1. The subscription stack. Start with what most people actually carry. Streaming services, not one, several spread across a household. A music platform. Cloud storage upgraded past the free tier because the device ran out of space years ago, and no one cleared it. A premium tier on an app that costs $3 more per month to remove the ads. A food delivery platform with a monthly membership that waives the service fee on orders that carry a 15% markup over the grocery store price before the tip is added. A grocery delivery service. A meal kit subscription that hasn't been paused in months. Each one individually is a reasonable decision. In aggregate, the household average runs close to $350 per month. That is $4,200 per year. Now run the math. $350 invested monthly for 20 years. At a 7% average annual return, 7% is the inflation-adjusted historical average for a broad market index fund, meaning a fund that holds a wide slice of the market and tracks it passively, grows to approximately $180,000. Not because you earned more, because the money compounded. Each year's return generated its own return the following year, $180,000. That number came from deciding not to cancel things. Part 2. Converting dollars to time. There is a framework used in retirement planning called the 4% rule. It is the principle that a retiree can withdraw 4% of their total portfolio per year without depleting it over a 30-year period. The math is straightforward. A portfolio of $1 million supports $40,000 in annual withdrawals. A portfolio of $500,000 supports $20,000 per year. Apply that lens to the $180,000 generated by the convenience stack. 4% of $180,000 is $7,200 per year. That is $600 per month in sustainable income from an invested portfolio, income that does not require you to work to produce it. Zero is not going to tell you that $600 per month changes everything. But here's what it does change: the date. The date you can stop. At $600 per month in passive income, you need less from employment to cover your fixed costs. You reach your retirement number sooner. The months between your current trajectory and an earlier exit, those are not abstract months. Those are mornings when your alarm goes off. This is not money. This is time. It is specifically the viewer's time. The number of months you will continue reporting to work, because this calculation was never surfaced. If this is already landing differently than you expected, the subscribe button is right there. This is what we do every week on The Vault. Part 3. The outsourced labor layer. The second category carries a different structure. Cleaning services, lawn care subscriptions, laundry pickup and delivery. Task apps where you pay someone to handle the things you would otherwise handle yourself. These are not entertainment purchases. They are not logistics premiums. They are the automation of personal capability, skills the viewer once had and could reclaim at zero cost. The opportunity cost here is double. The first cost is the fee itself, and it compounds exactly the way the streaming stack does. $60 a month for a cleaning service is $720 per year. Over 20 years at 7%, that is $38,000. The second cost does not appear on the invoice. It is the atrophy of the capability being outsourced. A person who has not cleaned their own home in 5 years, handled their own yard in 3 years, and uses a task app for anything requiring a trip they do not want to take, that person has quietly reduced their optionality. When the income contracts, and for most households, it will at some point, the ability to self-provide is a financial asset. It does not show up on a net worth statement. But its absence is felt. Zero is not saying these are wrong purchases. He is saying they carry a second price that does not appear on the invoice. Part 4. The threshold calculation here is a specific number. $250 per month, redirected from convenience spending into a low-cost index fund, beginning at age 28, compounded at 7% annually, held to age 65, 37 years of contributions. The projected figure is approximately $620,000. The median American retirement account balance at the point of retirement is approximately $87,000. Two numbers, side by side. Zero has nothing to add. Part 5. The design of frictionlessness. One thing is worth naming before this ends. The convenience economy is not incidental. It is not the accidental result of companies building useful products. Subscription models are engineered specifically for inertia. The default is renewal. Cancellation requires a deliberate action, often multiple steps. Sometimes a phone call, sometimes a retention offer designed to soften the exit. The cognitive load of cancellation is not accidental. It is the product, aggregated across a household, across a year, across a decade. The effect is invisible. No single charge feels significant. The total is never presented to you in one place. It is distributed across 12 billing dates, 4 credit cards, and 3 email addresses. Zero acknowledges this without anger. The system is functioning as intended. It was built to function this way. The only variable within the viewer's control is whether they ever ran the number. They just did. Here's what the subscription industry understood before most individual consumers did. The enemy of compound growth is not spending. It is recurring spending specifically. Spending that renews automatically without requiring a fresh decision. A one-time purchase of $200 requires the buyer to make a choice at the point of purchase. A monthly charge of $16 requires the buyer to make a choice to stop. The psychology reverses. Inertia, which normally serves the saver, has been redirected to serve the service provider. This is why the net cost of a subscription is almost always higher than the subscriber believes. Not because they cannot do the math, but because the math is never presented at the moment of inertia. It is presented once at signed up, and then it disappears. The charge becomes ambient. It recedes into the background of the bank statement the way rent does. The financial difference between ambient spending and considered spending, compounded over a working life, is not a rounding error. It is the gap between the median retirement balance and $600,000. If you are starting from zero, here's your first move. Pull 1 month of bank and credit card statements. Do not do this from memory. Memory systematically underestimates recurring charges. Find every subscription and recurring fee. Write the monthly total. Then run 2 numbers. The first, what that total costs you per year. The second, what it would be worth in 25 years at 7% if redirected monthly into a low-cost index fund. You do not have to cancel anything today. The exercise is diagnostic, not prescriptive. But the number you arrive at, the compounded figure, is the actual price of your convenience stack, not the monthly charge. The full price. Most people have never seen that number. Once you have, the decision is yours to make with accurate information rather than an incomplete one. The difference between what a thing costs and what a thing is worth, that gap is where most financial decisions actually live. You knew your monthly spend before this video. You did not know what that monthly spend would become over a working life, left to compound. Now you do? If someone you know has never run this number, this video is worth sharing. And the next one picks up exactly where this left off.